everyone, and thank you for joining us today. My name is Joshua Negrera, and I am the Acting Director at the Center for Real Estate Finance Research at NYU Stern School of Business. This webinar is part of the CREFA Real Estate Module Series, a new initiative at Stern to provide students and alumni with bite-sized learning modules focusing on topics such as affordable housing, opportunity zone development, and ground leases so far. We'll have several more in the coming months that will be available for both students and alums. In addition, my colleague Devin Cremines and myself have also developed a real estate interview series, which will focus on the COVID-19 pandemic and how real estate leaders are dealing with the associated fallout. This interview series will roll out next week. Today, we're thrilled to be joined by Omar El-Tare, who is a market analyst at Reonomy. Omar produces research reports and conducts original analysis leveraging Reonomy's extensive data set. Prior to joining Reonomy in 2019, Omar worked at BlackRock, where he advised global financial institutions on issues concerning capital markets, balance sheet management, and complex transactions. In today's webinar, Omar will discuss real estate trends from 2019 and review the impact of COVID-19 on the real estate industry thus far. He'll also take a look at past recessions to show what possible recovery may look like and what real estate investment opportunities may exist. On a housekeeping note, please keep muted and keep your cameras off if you can, and we'll have time for Q&A at the end of Omar's presentation. And on that note, I'll hand things off to Omar.
Great, thank you. First of all, I want to thank Josh, NYU Stern, and the Center for Real Estate Finance Research for letting me speak with you today. My name is Omar El-Tare, and I am the market analyst at Reonomy. For those of you not familiar, Reonomy is a property intelligence platform which was founded in 2013 and leverages big data, exclusive partnerships, and machine learning to connect various types of commercial real estate data together to present to users and support business decisions. Our data coverage really expands across the entire U.S. and approximately 50 million properties, everything from traditional CRE products such as multifamily, industrial, office, retail, hospitality, and lodging, to all types of land, including agricultural, timber, forest, vacant, to federal and state properties and beyond. There is so much that we do cover that I actually like to think it's easier to focus on what we don't cover, which is really single-family homes. But otherwise, we have the traditional and the niche, big and small, in gateway, primary, secondary, tertiary, and rural markets, and everywhere in between. Looking at the vast array of data that we are gathering, processing, and then providing our clients regularly, you can bucket it into three broad areas. First, there's property, then company and people data. Property data really describes the physical property details such as location, square footage, lot size, year built, property type, etc. Company data describes the ownership at the legal entity level and includes transaction data, including buyer, seller, amount, date, transaction type, ownership, entity details, as well as debt information. And then finally, the third bucket, the people. This bucket of data is unique and really a real value add for many of our clients. Our people data pierces the legal entity and provides our users with the owner details and contact information for the individuals who are running those entities and making the decisions. So we were able to provide phone numbers and emails. We have around 130 people who work at Reonomy. That's it. And yet we're able to bring all of this data together. So how do we do it? That's the question. And really the answer is what I consider as our special sauce. It's the real Reonomy differentiator. A seriously brilliant group of data scientists, product engineers, and some beautiful code. That's really the combination there. So the data and engineering team works tirelessly to make sure that our machine learning algorithms are running properly and that they are regularly rolling out enhancements. Reonomy as a company are backed by some prominent investors, including Bain, Georgian Partners, Sapphire Ventures, Citi, Wells, and the list goes on. We recently raised around $60 million in our Series D funding in the fourth quarter of 2019. We serve individuals and institutions alike. Our core client groups are really investors, brokers, lenders, as well as service providers. While some use our API to pump into the data and combine with their own data sources, others really rely solely on our app and data to source new business and inform their business decisions. Reonomy Research is a recently launched offering from Reonomy. It's really was created to provide a higher level insights into markets, property types, and trends. The objective of Reonomy Research is to further the understanding of U.S. commercial property markets by leveraging Reonomy's data. Launched about a month ago, we're looking forward to growing while contributing Reonomy's voice to industry conversations. And the way that we intend to do this really is through original analysis provided for free. We're publishing long-form reports as well as shorter but still in-depth topical reports and data-centric market glances, which provide snapshots of investment activity across a number of markets. I encourage you to check out our website, read our reports, and subscribe to our distribution list so you don't really miss out on any of the new content that we publish. Now, let's get to what we all joined this call for, to discuss commercial real estate. Before we dive into the more recent trends, I wanted to take a quick minute to look back at where commercial property markets have come over the last several decades. This historical context is important to note because while commercial property has been a part of our economy for centuries, it really has only been viewed as an investment asset class much more recently. But as it evolves, like other asset classes, and attracts more interest, competition, and capital, commercial property solidifies its role in the economy and the investable universe. Times are really uncertain right now, and there's a lot of fear driving speculation around the demise of certain property types and markets. But I would just remind everybody on this call, many of whom are actually students, or really to be students of history, recognize that even though these are drastic times, which they really are, they are still a part of the evolution of the asset class and will be looked back upon in the future as one of many drastic periods that the asset class will get through. Commercial property has not always been viewed as an investment asset class, and even when it was, it has only become more accessible as an investment in the last 3 decades or so. As commercial property markets have grown and become more mainstream, really, and this has been driven by lower barriers to entry, increased transparency and access to data. The asset class has experienced tremendous growth and gone through a great deal of change. Looking at commercial property transactions over the last 50 years, what we see is that transaction count has increased at a rate of 17% per year, dollar volume increasing at 24% per year, and median prices increasing at around 5% per year. However, if we were to look at the more recent 30 years, we can see that some of these growth rates are really overstated, and that the commercial property markets over the last 3 decades, while they have had positive growth trends, they've grown at a much more moderated pace. The total number of transactions over the last 30 years has increased at a rate of 6% per year. Aggregate dollar volume of these transactions increasing at 10% per year, and median pricing per square foot has increased at 3% per year.
As commercial property continues to mature as an investable asset class, its characteristics also continue to evolve. As demand increases and more money is invested, commercial property as a whole will become more transparent, liquid, and accessible to investors. However, the maturation will also likely continue to bring a slower pace of price appreciation for many markets. And while volumes have remained below the boom years leading up to the global financial crisis, the count of transactions has found a much more comfortable place in line. The increased count of transactions and steady level of volume are evidence that the overall liquidity for the market has increased, while price appreciation has remained generally positive since 2012. The year-over-year quarterly changes, as you can see here, have been trending downward. Now that's really, that's just kind of, I know that that's really kind of like high level, and I think that it's important that once we have that historical context, we can get caught up on kind of like the more recent events. And so heading into 2020, most market participants were expecting the year to be overall positive. There were some areas of uncertainty on the radar for many. Some of these examples would be ongoing trade negotiations with China. There was U.S. elections were also on everybody's mind. And also just kind of our position in the longest expansion on record. But there was no or really little expectation for a global economic recession. U.S. commercial property markets were benefiting from really over a decade of positive growth and general optimism. However, within the first quarter of the year, all of that has changed. Pandemic really has triggered fear and uncertainty across the global economy and all markets, including the U.S. CRE space. The speed and scale of this global shutdown and the response to counter it have really not been seen before. And this is one of the reasons why there's so much speculation out there now around the magnitude and the duration of the change that we face ahead. The decade-long economic expansion really has come to a very sudden and severe halt. Commercial property value is driven by supply and demand for commercial space, which is driven by economic activity. So while real estate is not at the heart of this crisis or this recession, commercial property will not be spared the pain ahead. The way that this crisis has a lot going on, and it's still developing, and there are so many unknowns at this point. However, at a time like this, when it's really easy to get distracted by all of the unknowns, I think that it's very important to take stock of what we do know. To get a better sense of what's happening now and setting expectations for going forward, I like to think that the current crisis that we're going through is really actually three parts. There's a health crisis, a liquidity crisis, and a solvency crisis. The health crisis really stems from the virus itself. And this crisis it poses capacity strains on the healthcare system and has put pressure on governments and society really as a whole to limit the spread and by limiting interaction through travel bans, social distancing, and really large-scale economic shutdowns. This is the first. This is really the first piece. And it's still happening now. Everybody is affected, but the duration is really unknown. We're starting to see some easing of lockdowns, but these will likely only be partial at least until there's a vaccine or cure that can be produced at scale and distributed to the majority of the population, or until we achieve herd immunity. The second piece of this is really the liquidity crisis. And given disruptions in supply chains, as well as changes in consumer behaviors, many businesses have significant challenges when they're trying to meet their near-term financial obligations and commitments. And this has really resulted in significant budget and headcount reductions, which then spreads the liquidity concerns and crisis not only at the business level, but then also to the individual level. And this comes to play in a lot of pushback or lower rent collection. So the liquidity crisis is also happening now. And while it's following the health crisis, it is they're concurrent. The mitigation efforts have been as significant as the pandemic itself. We've seen the Fed roll out or bring back actually a number of its global financial crisis programs. We've seen TALF as well as Main Street Lending Program, but then also the federal government with the CARES Act and I guess where commercial real estate is impacted is really through PPP as well as mortgage forbearance and tax relief. All of these programs are attempting to mitigate the downside. However, how effective they'll be is still to be determined, and whether or not another round is needed is also an open question. The duration of the liquidity crisis component is also unknown. I would say that it really comes down to the timing of when the economy as a whole opens again, or when businesses ultimately shut for good. And then the third piece is really the solvency. And as the crisis continues and the future remains uncertain, many companies and individuals begin to see challenges with meeting their longer-term financial commitments, and their solvency comes into question. And while the sequence is known, as it follows both the health crisis and then it follows the liquidity crisis, the timing of the solvency and kind of like the flood of insolvent companies is still to be determined. However, that being said, expectations are really that it's building up now and will likely start to really reveal itself as economies and the courts open. The fear of insolvency is really adding pressure to state and federal governments to open economies. However, as many scientists and doctors have made it clear, that if it's done too soon, this could actually trigger a second wave of the health crisis, and so then we're starting this vicious cycle once again. So that's really kind of how, at least how I'm thinking about the crisis. Even though it's one crisis, it's three. It has three parts that feed into each other. But what we are seeing is we are starting to see data reveal the severity here. So the pain and the loss of the crisis has been felt acutely by many across the country. I extend my sympathies to those who've lost loved ones or have really suffered major financial or career setbacks. This is a devastating time for many. The dire situation is really only starting to reveal itself in a lot of the data, though. This is the beginning of what I would expect to be a lot more, I would say, negative numbers being revealed in the coming months. The economic pain is really not felt evenly, with clear discrepancies being revealed by across different industries, different sizes of companies, and different locations. Even though I know we're all very, very aware and of the hits to GDP, the hits to employment, I wanted to call out a few numbers that I think really jumped out to me and capture the severity of the crisis, and as they translate to risk within commercial property. So this minus 39%, or roughly 40% of small businesses are closed. If these companies are not making money, this means that they're going to have a tough time or will not be able to pay rents. And also the second order impact here is that that as these companies are closed, they're not able to make money, so they can no longer employ their employees, which that has implications not only further down the line for consumption, but also for paying rent. And the 20% down is this is the total return for REITs as of the end of April. The interpretation here is really that these are some of the best managed assets. They tend to have the higher quality tenants, and they've already lost a fifth of their value. And that's, I think that if you look at retail and lodging and hospitality, they've lost nearly 40%. And then this last number, 3.6 trillion. This is really fiscal support, and this doesn't take into account Fed's actions. And this is also, we're still potentially in the early innings here. This may not be sufficient. So one of the challenges with the crisis is how fast it's moving. The situation is currently unfolding. However, the data really only captures the past, right? And on top of that, commercial real estate tends to be a bit more lagged. Deals are, take time to not only arrange, but also execute. And so what this means is that the data that we've seen so far is not accurately capturing the extent of the current crisis. And so this is where I would say that actually relying on anecdotal evidence can be a good indicator of what's to come in some of the hard numbers. So what we're hearing, or two things that I want to highlight, is on the lending side, whether it's from insurers, banks, funds. Lenders are generally shifting focus from origination to risk monitoring and management. They're tightening their underwriting standards, really favoring borrowers that they've worked with before, being very strict with their LTV. They're lowering their LTV limits and DSCRs, and credit's becoming less available. And also, of their current book, I would say that you're hearing that more assets are being transferred to watch lists, special asset groups, and then also special servicing. And then on the investor side, deals that are being closed are largely deals that were in the works pre-COVID. Deal-making activity is significantly lower now than it was in the first half of the first quarter of 2020. Some investors have walked away from transactions that have been in the works, really preferring to pay any sort of penalty to get out than actually go ahead and close. And pricing is beginning to face downward pressure. And then a final thing to note is that you've heard of, or I'm sure you've heard of, and you can see it in the news, of a lot of distressed investors are starting to get a little bit more media attention, as there's growing interest in distress. They're not only raising funds now, but they're starting to do due diligence around when they are ready to deploy their capital, where they're going to go. So the expectations really across the industry are to to dust off the recession playbooks. And so with recession really on top of mind, we thought it might be useful to highlight some of the research that we've done around past recessions and how commercial property markets have reacted during broad economic contractions that may or may not be real estate centric. So in the research that you're about to see here, and that I'll share some of the highlights with, comes from a recent report that we just released. It is free. You can download it, the full report on our website, and we can make that available to you after the call as well. But in this report, we take a look at the last 50 years, and within those last 50 years, there are 7 broad economic recessions in the U.S. Each recession really was different in terms of duration, severity, and cause. However, there were a number of shared characteristics that we highlight in the report and discuss in more detail, but then we also highlight here that were preceding each recession. So that's what you see on the left-hand side. And then on the right-hand side, what you see is that the impact to commercial property activity. And because each of these recessions was different, as you might expect, the impact on commercial property markets also differed. And because the directional impact of these broad economic recessions on commercial property market activity and pricing was not constant, we go ahead and we actually introduce a new metric to capture the overall impact. And that's what you see here. So this is really using the frequency of the negative impact that commercial property markets experienced during a broad economic recession, as well as the severity of that impact. We calculate what we call the recession impact. And then what we've done here is we've just shown kind of like the last 7 recessions, right? So going back the 50 years, and kind of the overall impact that each of these recessions had on commercial property market activity and pricing. And so what we see here is that during the last recessions, the count of commercial property transactions fell by an average of 5.3%, dollar volume by 16.4%, and median pricing around 11.7%. Now, of course, the recession experience really does differ quite a lot by region, specific MSA or market, and property type, and any of the combinations of those. And we explore those in more detail in the report. But I'm just showing this now just so that it's a kind of like it's useful to kind of contextualize the commercial real estate performance during recessions, even if it's just to help put kind of like bounds on the ranges of expectations. Now, while many are trying really to size the recession in terms of duration and severity, there's a lot of thought actually also being given to kind of so if we know that we're going to go into a recession, well, the next step is looking at kind of like what will follow. So that's really giving thought around recoveries. And pulling, I'd say, this is additional findings from the same piece of research. We found that if history really has taught us anything, it's about the importance of considering market growth in relative terms. The relative speed of that which a population center grows compared to other population centers, really appears to have a significant influence on overall market activity and pricing, more so than just the absolute speed of a given MSA's population growth. And so one way of looking at this is that markets with rapid or above average population growth experience higher price growth, but this really comes at a cost of higher pricing volatility. And so what we've done in the report is we moved a bit away from the primary, secondary, and tertiary definitions, and we introduced these 5 definitions that you see here: arrivals, departures, stalwarts, steady, and rural. And this really captures it's almost capturing the momentum or the speed at which these markets are growing, as well as their kind of like starting value. And this is the reason we did this is because when looking over 50 years of data, something that was a secondary market, like 50 years ago, may not be a secondary market now, or it may have moved up or down. And so we're trying to capture those moves as well as their current position. And what we found here, and kind of like I would say the takeaway is that I like to make an analogy between or to the stock market, that if the overall population growth rate of the U.S. is representative of the market, then and we'll take the arrivals, for example, that the arrival MSAs, which have above market growth rates, have behaviors that are similar to higher beta stocks, and really are subject to bigger ups, bigger downs, but they have much more regular levels of market activity. So that's transaction count and volume. So if one were to really apply this concept to the current situation, one might expect to see an arrival MSA, such as Austin, experience really outside swings or much more price volatility during the recession, but also recover quicker coming out of the recession than something like one of the departure MSAs, such as Detroit. And while Detroit might have more stable pricing, Austin will have greater liquidity. Also, on the topic of recovery, one thing to note, and one thing that I find really quite fascinating, is that the recovery speeds of market activity as well as pricing really are greatly impacted by the impact that lenders or the hit that lenders have during the recession. So what you see here is that we're summarizing the historical recovery speeds of market activity as measured by transaction count and pricing. So the numbers here are representing the recovery speeds in terms of months, or put another way, for each month of economic recession, it takes a given market X months to recover. And the X being the numbers that you see here. Once again, these numbers capture the historical experience and are really meant to help contextualize the present, but not really predict the future. And while there are differences between the recovery speeds for property types and market types, one of the most significant determinants of recovery speed really appears to be the severity of the impact to commercial property lenders during the recession. And this is what we're highlighting in the different columns that you see here: one, lending and non-lending. So given that a that given that commercial property is generally financed with debt, lenders really do play a key role in keeping the markets alive and functioning, and they play an even more important role in the recovery. So after recessions where commercial property lenders were more negatively impacted, the recovery speeds of commercial property market activity was twice as slow as the recovery following recessions when lenders were not disproportionately hurt. And then this 2x really is closer to 10x when it comes to prices. So when setting expectations on recovery speeds of pricing and market activity, it will become critical in these next few months to really watch the lenders, specifically their lending standards, their loss provisions, as well as REO levels. All right, I'm trying to get caught back up on time here, so I'll try to go through this last one quickly, and then we can open it up to questions. But the crisis is sending a number of mixed signals across the different property types. It's done really an amazing job of accelerating some trends that were already underway, nearly halting others, and then also introducing some new open questions. On one end of the spectrum, you have industrial, which really will come out of this with a net positive impact. The demand for last mile and fulfillment centers has really has been given extra fuel. Also, the interrupted supply chains and troubled or paused trade negotiations really makes a case for at least partially moving away from, I'd say, global supply chains and bringing, where possible, more production onshore, as well as there is some move away from, in a case that could be made, to move away from just-in-time inventory management. On the other end of the spectrum, you have retail and hospitality. For retail, the current crisis has accelerated the deleveraging of balance sheets through bankruptcies and expedited the decrease of physical footprint through store closures. These really have been underway for many years and were expected to continue. But this crisis is turning what was once a steady pace of closures and bankruptcies into a massive wave. Also, so long as social distancing is on government and consumer minds, there's a real challenge posed for any sort of experiential retail. Lodging, as I mentioned, also is dramatically hit. But this, I would say, kind of the silver lining is that hospitality has traditionally been a boom and bust property type, and many expect it to continue to be. While this current bust is much more severe, there are pockets of light in an otherwise dim picture. Long-term, I would say, economy and extended stay are two of those bright spots. Some of the larger operators have also that have strong enough balance sheets have also suggested that they will be getting acquisitive during the coming months and quarters. And then I would say the cases for multifamily and office are a bit mixed. On the office front, companies that were able to adapt to working remotely will likely keep some of that in place even as we come out of the recession and into the recovery. Greater flexibility for employees and cost savings for employers really look like promising incentives, which would decrease the demand for office space. And and then I would say that you would expect to also see if there is a wave of foreclosures or of bankruptcies, that there will be a lot of space coming to market. But in the long term, I ultimately view that we are social creatures, and that many office occupants will benefit from having at least some space where collaboration in person can continue. And then finally, I'll touch on multifamily, is that this working remotely will also serve as a tailwind for millennials to continue to push towards warmer weather and lower cost of living locations. However, I would say that the current environment has raised concerns across many residential properties with regards to ability to collect and future rent growth. Finally, across all property types, I think that the current situation is really raising a number of questions that will be answered in the coming quarters, and will inspire what otherwise is I view as like creativity. These are questions around business model flexibility, the role and necessity of corporate headquarters, cooperation and kind of negotiation between owners and tenants, new lease terms and structures, and expectations for future rent growth. I think that those will become more clear, but these are, once again, areas of opportunity for creative ideas to be introduced. And so I know I kind of rushed through a lot of that there. Josh, I will, if it's all right with you, I'll open it to Q&A, and hopefully we can go maybe a little bit longer if there's a demand.
Sure, that would be great. And we had some questions submitted via the registration form, so Devin will go through those just to give those people who already submitted an opportunity.
Awesome.
Yeah, Omar, thanks for sharing this with us. Kind of one of the first questions we had come in was, do you have any data, or can you speak to maybe how this affects kind of the New York City submarket? I know we looked at a lot of macro level data here today.
Yeah, absolutely. Yeah, so I think that in the near term, New York is going to suffer more. This is largely because, if you just look at it from the health crisis perspective, it is very pronounced here. It is quite devastating. It has really changed the city in the short term. In the long term, I still believe that the large population centers that are employing kind of high-paying jobs will continue to attract and essentially retain not only residents but workers and consumption, right? So even though I think it's really devastating what's happening to the New York restaurant scene as well as the retail scene, I think that it's something that will eventually bounce back. This is something that it's part of the culture. I think that it is so much art, so much identity is here that the pain that is being felt now is temporary. And hopefully that's addressing the question. If not, I'll happily answer kind of like if there's a follow-up, happily dive in there. Devin, did that answer? Or we can move on to the next question if there's no follow-up.
I think we can move on to the next one. What do you feel like will be the correction in multifamily prices during this crisis?
Yeah, I think that it comes down to the tenant. It really ultimately comes down to the ability to collect rents, right? I think that there are niches that are really going to essentially continue to have downward pricing pressure. Those particularly being, I think, senior and student housing. I think the case is much weaker going forward for both of those. And there was already getting to the point where it was looking a little bit frothy heading into this pandemic. But generally across multifamily, pricing will, I think that there's going to be, there will be some downward pricing across like the market as a whole. And that's going to be largely because of, I think it's going to be tougher to compete on amenities. I think it'll be tougher to also, I think, justify future rent growth. With unemployment close to 20%, I mean, if you just think about it's easy to, you can get fired in a day, but to find a job usually takes multiple months. And so this is something that's not going to be corrected super quickly, right? I think that there's definitely a difference between, not all jobs were lost. I think a lot of the Class A, higher end multifamily is less affected. They usually have tenants that are likely in, or more likely to be in industries that were less impacted, or maybe not always less impacted, but were able to make the adjustment much more easily. If you take tech or finance, for example, or a lot of business services, these are not only high paying, but they were also able to much more quickly adapt to the remote work than I would say a lot of retail and like food and beverage, right, has been absolutely crushed. So I would say that there are pockets of continued strong performance, but that being said, there are, like, across the board, multifamily does face some headwinds, but it is, still, one of the, shelter is critically important, and people will continue to pay so long as they can.
Yeah, thank you for that. And kind of a follow-up question to that, which is another question that we had come in, is do you see any specific multifamily submarket being, more affected than others?
Yeah. So, and one thing we didn't touch on here, and we're putting out a piece on this, is that, one of the areas that I feel hasn't gotten enough attention is really the energy markets, right? So look through a lot of Texas. If you look through like Oklahoma, these are markets that were absolutely devastated. Not only the pandemic, right? So you have the health crisis. You have and then you have an industry that is absolutely getting is going to be going through some really large structural changes, and a lot of those economies had very large exposures, like outsized exposures, to an industry that not only was, I would say, arguably in kind of like a long-term decline, but it will. I don't think the energy industry in the U.S. is kind of like doubly impacted, and those jobs aren't going to be bouncing back. Many firms are lost for good, and will not reopen. So I would say look towards energy markets and essentially energy markets. So I think a lot of kind of like in and around Texas are examples.
Mm-hmm. And then last kind of submitted question that we had come in was, how do you see this pandemic playing out in terms of like the real estate note marketplace? Like
whole loans, or sorry, I probably shouldn't ask follow-up questions.
No, it's okay.
The real estate note market, I would. Oh, that's a good question. I would expect to see whoever asked this, hopefully they can reach out to me if I'm not answering what they want right now. But I think it's going to be almost like I would say like a revival, right? In many ways, you'll see many more notes coming to the market, and I think that this is, I mentioned that you see a lot of people dusting off kind of like the recession playbook. This is something that I anticipate more attention to be given to, as banks are really in the business of lending, not owning real estate. And as they get more and more real estate onto their books, they're going to be looking to offload this. I think that this is something that and kind of get ahead of those problems. The number, you can also look at kind of like the number of loans that are being transferred to special servicing. That's starting in the CMBS world, that's starting to tick up. And I think that will be another feeder or outlet for kind of the note market to pick up. And so I would say, like, volume wise, I think that this is kind of like a known section of the playbook that many people are starting to get ready for and revisit.
Omar, one question that I think would probably be something that a lot of our listeners would be curious about. A lot of our students are very entrepreneurial, but a lot of our alums have gone into the real estate industry. For one example, let's just say you have $5 to $10 million to invest in real estate. Given what you've seen from the data in the past with recessions, which property type and which market type would you want to invest in if you say have a 5 to 10 year investment period at this point?
Do I get to choose? Yeah, if I get to choose the tenants, that's huge. But I would.
And with that relatively small size of investment, we're obviously taking hospitality out of it, unless you do a small kind of thing. So.
Yeah, I mean, I love that question. I would honestly, I would probably go, because I am convinced, like, I really do think that, what we're experiencing now is not a new normal. I don't think that we will get quite back to where everything was, kind of like December or January of, I guess January of this year or December of last. But I think we're going to be somewhere in the middle, right? And so I still personally, I love New York, and I think that the case for urbanization and kind of like, for me personally, I do like that, and so I would probably. I would find a large population center, and Like honestly, yeah, I personally love New York right now, but I don't advise any. I don't advise. I don't I don't make recommendations for really investing. But
This is just a database question. It's not, you're not giving anyone investment advice.
Gotcha.
So we'll clarify it by saying that. So in terms of the market types that you've described, you would say an arrival market and property type.
Yeah. Actually,
Arrival.
yeah. So I would take that back. Yeah. So I would definitely go arrival. And I think that if I'm being kind of like pretty opportunistic, I actually think the retail case, I actually do like the retail case in arrival markets quite a bit.
Okay, great. And we can attach your report as a follow-up after this to all the attendees and anyone who registered. So they'll be able to take a look at the arrival markets within that literature and also get some more information based on what you've talked about today, right?
Yeah,
Okay.
Absolutely. And happy to also answer any questions if people want to follow up with me. So.
Yeah, and if anyone who's listening right now wants to chime in and ask a question, I know we did have one question submitted through the chat. It was about one of the slides that you're going through that had lending and non-lending. They said, are you referring to encumbered or unencumbered properties? Otherwise, I don't understand how lending impacts recovery.
Yeah, so I believe this is the one. Yeah.
Yes. Yeah.
So so this was looking at ultimately this is looking at kind of the recessions. So in the early 90s, as SNL, like the SNL crisis, like hit the commercial real estate like lending community much harder than in other recessions, as well as in the global financial crisis. Lenders were also hit quite hard. And so the lending versus non-lending is really comparing the recovery speeds of the different crises and either including or excluding the what I labeled as like lending crises, right? And non-lending crises. So this is a higher level, this is not going through looking at individual like assets. This is more looking at kind of like the shape of the recession itself and whether it's almost a binary of whether or not it impacted lenders more or less. And then it was including or excluding. Did that, yeah, hopefully that answered the question. If not, happy to also hop offline or continue this on.
Great. And does anyone from the audience have any questions? You could just chime in, take yourself off mute and ask.
Hey, Mark Sheeran here. Quick follow-up on something you said in multifamily. You mentioned headwinds in student and senior housing. I think student housing clicked for me. I get that. Senior housing, though, I was wondering if you could expand on that a little more. I would think that the baby boomers coming through would still spike demand on that, but I might be missing something.
Yeah, so that's been kind of a so that was part of a I'd say like thesis that's been around for a while. However, there's actually kind of oversupply of senior housing, and there's been a recent trend that a lot of the boomers are actually preferring to stay like kind of age in place, right? So the demand hasn't kept up with the supply. And I would say that a health crisis like this really, and in particular this health crisis, is which is much more dangerous to certain demographics. That's much more pronounced with like senior housing, and I think that continues, and that's why it's a tailwind for downward price pressure on senior housing. So I think that the trend already in place was that there was oversupply and that that demand wasn't quite keeping up with it. And I think that this just exacerbates that. Let me know if that, hopefully that clears
Yeah,
it
no,
up a bit.
that was great. Thank you.
Yeah.
Omar, I have a quick question to that point. There's been one professor at NYU Stern has talked a lot about the post-corona world. He speaks to a little bit more of like the branding and marketing side. But his kind of point has been that the post-corona world coronavirus is less of this seismic shift and change, and it's more of just an intense accelerant to trends that were already happening. And anyway, that thought just came up when you were talking about the trends that you're already seeing in senior housing and kind of how this has accelerated that. Do you feel like that is true in terms of the trends that you're seeing all across asset classes and markets as you're evaluating this data?
Yeah, I really do like that quite a bit. I think that it definitely is accelerating a lot of trends, right? And that's where it's like it's most pronounced really with retail, right? A lot of the kind of like devastating stats or things that are coming out of the retail space, those were already, I remember like it was probably 7-8 years ago talking about kind of like dead malls, right? And that or kind of like the pain that retailers were facing, and still talking about it, right? So I 100% buy that it's accelerating some. I also think that it's somewhat, it is a little bit of a, and that's why it's like, I could have used accelerating for tailwind and like decelerating for headwind on this. So I do agree with that, but I don't think it's one way. I don't think it's only accelerating trends that were there. One of the, I do think that it's also introducing, it might not be a whole new world, right? That like post-corona, but I do think that there are going to be new considerations being made. And where I see that playing out most is really kind of in this first point of in the bottom section is really business model flexibility. That is working from home, but that's also just the ability to toggle between working from like remote work and kind of like the traditional like office work. This is the ability to transform office space. This is the ability to have multiple channels of revenues that if you are a retailer, that you're able to switch between. That you can operate as a you can have dining in, but you also have picking up and delivery, and then perhaps if you're like a kitchen owner, right? Perhaps you actually consider, like, rather than the space being down, that perhaps you utilize it as like and rent it out as like essentially ghost kitchen, right? So I do think that the world will be different, but it will not be dramatically different. So I do agree with the professor quite a bit that like this is accelerating a lot that was already underway, but I don't think it is a one-way. Like I don't think that just focusing on what it's accelerating is not capturing everything that will change. Like speed is not the only thing that's changing. There are a few new variables.
Kind of going off that as well. Since we've seen a lot of work from home now, and you did mention that there's a possibility that millennials and younger workers will go to cities that are a little bit warmer, be able to take advantage of newer rising cities and things like that, since they have the flexibility to work from home. Do you think there will be any flight to the suburbs or people exchanging longer commute times since they will be able to work from home part of the time?
I've read a lot of other opinions about this, It hasn't fully like settled in with me. Like, I don't think that's, and what I mean by this is the shift towards like, in the demand for single family, whether it's single family rentals or actually purchasing single family. The reason why I don't fully, I haven't, I guess, I'm not fully convinced of that yet, is I still think that so a lot of the, one of the reasons why millennials weren't shifting to single family right now is largely because they're still not forming households at the same pace that past generations have. And I think that this crisis is, hurting them and is an additional burden, or at least an additional delay for that to start happening. And so, yeah, I do think that there is a case to be made that yes, if you're going to work remotely, like, why not work in the suburbs? However, I think that the same case could be made. Okay, if you're working remotely, you know what? I'm actually not going to live in the same city year round. I'm actually going to do 3 months. I'm going to do 6 months in one city. Then I'll go over to the next. And I could be chasing chasing warmer weather, or just splitting my time between the coasts. So I'm not saying that I disagree with it, but I just have not been fully convinced.
Great, thank you. Do we have any other questions from any of the participants? All right. I'll take this as an opportunity to thank Omar once again. Thank you all for attending and joining us. As I mentioned, this has been recorded, so we will be able to distribute this, maybe with some slight editing from the beginning. Thanks for hanging in there with us with the audio problems. We'll also distribute some of the literature that Omar spoke about, and we'll also give you the link to Stern Network. So hopefully during this time, you could start networking with some of your alumni colleagues and some current students who I'm sure can use some advice. There are also several students that are available for remote internships. If anyone is interested in that, just feel free to reach out to me. Along with that, we'll send you Omar's email address if you have any follow-up questions. Thanks again, everyone. We really appreciate it. And Omar, if you have any closing remarks.
No, thank you very much. I really do appreciate everybody hanging in there. And